Let's talk more about all this. Joining me now is Kevin Gordon. He is the Senior Investment Strategist for Charles Schwab. So glad you can come on the show today.
Thanks for having me. Good morning.
Good morning. Watching the Russell 2000, it's gained over 9% just over the past month, well above the other major averages.
Yeah.
What do you think is driving this recent small cap rally that we're seeing?
I think, definitively, where you started to see the biggest shift and kind of knee-jerk reaction was after the CPI report that we got not too long ago. And that's when you really started to see, not only a rotation out of what had been working, up the cap spectrum, specifically within areas like the Magnificent Seven as a group, and then into small caps, but you really started to see some legs in areas of small caps that just had not been doing well. Most notably, this kind of low-quality, non-profitable trade, which has pared back a little bit, and now it's gone more into the higher quality parts of small caps, which I think is a good thing. But it was definitively, I think, the CPI report, in conjunction with, an understanding or at least an expectation that, now the Fed is probably gearing up, to cut rates at some point, and assuming that inflation remains in this downtrend and you get more softening in the labor market, probably pulls a rate cut in September, on the table more.
So let's talk about small caps, though, because we understand that you think that small caps can be susceptible to, a more of a negative catalyst. Why is that?
Well, what's interesting is that, especially if you take an index like the Russell 2000, about 40% of members in that index have no earnings. So you're already working with a pretty, low quality index, especially if you compare it to something like the S&P 600, which has more of a quality filter. So it doesn't make the Russell 2000 bad in and of itself, but we just use that example, especially for our investors, to kind of manage expectations as to what you can expect from small caps, especially because this cycle has been so unique where, even in the first year of the bull market for the S&P 500, the one that started in October of 2022, the Russell 2000 was actually down. It didn't make its bear market low in 2022. It actually made it in 2023, a full year later. So there are a lot of disjointed parts of this cycle, and for small caps in particular, one of the frustrations has been, I think, that we've been in this higher for longer rate scenario for almost a year now, where rates have been, the Fed has been on pause, and you typically start to see outperformance after they go through an aggressive cutting cycle, and then once the economy is rebounding. But everything is so disjointed in this cycle that we don't think you can expect small caps to act the way that they would normally do, in a so-called typical cycle.
Right. Can we expect small caps to if we look at this sort of further into the future, to react more predictably then?
I think parts of it. And what's nice actually is that if you look over the past year, and if you just use the single criterion of profitability in an index like the Russell 2000, you look at the companies in that index that have profits and those that don't have profits, the ones that are profitable have been outperforming the non-profitable ones by almost 20% over the past year. So if you're a small cap oriented investor and you're a little bit more active and you've been screening for profitability and just high quality in an index like that, you've been able to find outperformance. You're just not going to see it at the index level. And index math really matters when you start to talk about the Russell versus something like the S&P 500, because consumer discretionary, industrials, and financials make up half of the Russell 2000. So you need to see a lot of movement there, and a lot more convincing movement, which we have seen for certain parts of financials. Russell 2000 financials are at their highest since February of 2022. But you need to see those groups start to participate even more, and those are more cyclically oriented. So if the economy is still struggling and still in this sort of sluggish motion, where parts of the manufacturing, housing, and consumer sectors are still taking time to recover, it's probably going to be hard for the aggregate index to recover as well.
All right, so we're entering the heart of earnings season here. What do you anticipate that we'll see from small caps, and how much disparity do you think will be between the Russell 2000 and the S&P 500?
Yeah, so estimates, for the back half of the year are still relatively optimistic. They've been pared back as you've gone, throughout the year, throughout the first half of this year, where revisions have come down for the Russell. But I think what has been, encouraging is the fact that now you're finally starting to get some movement from forward estimates. Hasn't been nearly as strong as what we've seen for the S&P, but the onus is more on the part of small caps to actually deliver on earnings, because if you look at the breakdown of gains over the past year or even year to date, for the S&P, there's been participation from the earnings side. It hasn't been all multiple expansion. Very different case for the small cap indexes, where it's been basically all multiple expansion and earnings growth hasn't really delivered. It's only started to kick in recently. So I think that you need to really start to see earnings come in. And in addition, I think everything on the sales side and top line strength as well, for the bull case to be strengthened there. Because if it doesn't, then you're probably going to get a little bit of this confirmation that this was more of a great reaction, not as much of a great rotation. But I think that for the most part, when we wrote our outlook for 2024, we were relatively optimistic in the fact that earnings were going to improve for small caps in the back half of the year, but not as much in the camp of they're just going to overtake large caps and completely, shift the leadership spectrum.
And something else in focus for investors is, of course, the election coming up, the presidential election. Why do you believe that strategists, analysts, and investors, they kind of need to stop with the Trump trade, with the Harris trade when it comes to talking about the markets?
Well,
do you think it has no impact on market activity?
I find that it's interesting to me when I continue to see this terminology come up as the Trump basket or the Harris, but it was the Biden basket, now the Harris one, especially based on what has performed or didn't perform well during Trump's administration and what has or has not performed well during Biden's administration. I use the energy sector as an example with clients or whenever I'm speaking with folks like you. The conventional wisdom was that energy was going to do relatively well under Trump because of friendly rhetoric around the space and potential policies, and then vice versa under Biden. But it's been the exact opposite case. Energy was the worst performer while Trump was in office. Energy's been the best performer since Biden has been in office. So I think that, and there's many more examples you can look at, whether it's banks, whether it's real estate, but the idea that the cyclically oriented deep value trade is only going to do well if one party takes the White House or the other, I think that needs to be ignored. I think what needs to be put more in focus is macro forces and what's going on with the cycle, especially because we're in such a unique cycle relative to history.
So do you think that the markets just don't react to policy changes, which can be spearheaded by presidents?
I mean, there could be knee-jerk reactions for sure. I just think over the long term, especially if you look throughout history, it's hard to tie performance specifically to either a policy or a presumed policy, because you have to keep in mind we're just candidates right now are just talking about what they would like to do or what they maybe expect to do. There has to be the congressional part taken into it, and then the eventual actual sifting out of what the meat is going to look like in a potential piece of legislation.
Right now, it's all talk. Kevin
Exactly.
Gordon, thank you so much for your expertise.
Thanks for having me.
Appreciate your time.
Thank you.